Hi, I'm Chris Stewart, Director of Investments for Impact Advisors Group, and I'm here with my now old pal, Jonathon Shelon from KraneShares, to address some questions that I'm hearing a lot from investors. Specifically, stocks and bonds don't always give you the diversification that you used to get in the past, especially in the COVID market of 2022 when they moved together. So how do we address that going forward? And Jonathon here has worked at Fidelity and at JP Morgan, has managed billions of dollars, and is a long history in the industry. And I'd like him to talk a little bit about how the 60-40 portfolio just doesn't cut it so much anymore, and how that led you to the current wealth models that you recently launched.
Chris, great to be here with you, and thanks for raising this important topic. When we think about 60-40, it's kind of hard to actually poke holes in it over the last 15 or so years because it's done so well. If you look at the returns of a 60-40 portfolio, just stocks and bonds, it's up over 400%. In terms of return. So that's a very strong cumulative return. Annualized, it's over 10% a year. And that's kind of the return that you've historically gotten from just stocks. So the fact that a stock bond portfolio did that well has lulled us a little bit into complacency. And so I think the purpose of this conversation is to say, geez, it's done really well. But do the last 15 years mean that the next 15 years or even the next 5 to 10 years are going to look the same? And we're starting to spot some things that give us pause.
So let's start with alternatives. To some people, it's kind of a scary word. It has the trappings of being very liquid, very volatile, like hedge funds, private equity, etc. Can you tell us what liquid alternatives means and how the market has changed in the last few years?
I think that's right. When people hear the word alternatives, they think of some of the success that large institutional investors and endowments have had, mostly with hedge funds and private equity and venture capital and real estate. But in this modern world of model portfolios where you can literally construct a fully diversified strategy using ETFs, liquid alternatives become the norm. And what those are also strategies that don't have the same pattern of return as traditional stocks and bonds. They're going to move differently. So in a year where stocks are up, liquid alternatives may be not up as much. And some may even be down. But the idea here is to put things together that have low correlation, that don't move together. And the nice thing is now with the innovation that's taken place within the ETF universe, the ETF ecosystem, a lot of strategies that historically have never been available or never been accessible to an investor, and certainly not in a liquid wrapper, can now be accessed. And so we're big proponents of building portfolios using liquid alternatives because they preserve the liquidity that you want, but they also give you this diversification benefit that historically has been hard to gain.
Yeah. Let's unpack that a little bit because it's not always intuitive that adding something like alternatives can lower the overall risk in the portfolio. But at the same time, let's be clear, we're not really accepting a lot of lower returns in that space. We expect these to perform well, but just perform very differently. I believe that's the case.
I think that's right. If you think about liquid alternatives, it can encompass a wide range of strategies, and those strategies have different return profiles themselves. But the idea here is by introducing alternatives into a portfolio, you can reduce the volatility. And why is that important? Well, there's kind of this geometric effect that occurs in returns, especially when you lose money. So if you take $100 and you lose 20%, you're down to $80. Well, how much do you need to break even? Now you need 25%. So you lost 20%, but you need 25% to break even. So just by cutting your losses, changing your drawdown profile in these difficult markets should help not just stabilize the ride, make it a smoother ride, but also help you recover more quickly and achieve better returns in the long run. And so when we talk about liquid alternatives in our portfolios, we're usually investing a sizable portion into alternatives, but also doing it across a wide range of such strategies. Things like carbon credits, things like managed futures, things like options-based strategies where you can generate income by writing calls. These are all the types of investments that we think help broaden this diversification.
That's great. So maybe I'll take a half a step back and say, by the way, we're not putting half the portfolio in these things.
Definitely not.
Right.
Definitely not.
So in our 100% equity portfolio, we're looking at 20% in alternatives because it has to be meaningful enough to give it. If you have diversification of 5% of your portfolio, it's not going to help that much.
That's right. That's right. So, and that's what we're also realistic about. We don't want to do something cosmetically. We want it to have a real impact. So our portfolios have between a 15 to 20% allocation to this alternative sleeve. And we found that that's about the sweet spot. What it does, though, of course, is it takes allocations away from stocks and away from bonds. So what you're able to do is reduce your stock and bond mix. So the 60-40 will have less than 60% equities, quote unquote. That balanced portfolio will actually have a little less equity, but it'll have more alternatives. And again, we believe that you're able to generate similar types of returns with less risk, or as they say, more efficiency.
Well, you mentioned two of the strategies, which are fascinating carbon credits. We can talk a little bit about that. Really more outside the U.S., the direction of trying to deal with climate change has been putting a price on carbon. But maybe you can spend a minute talking about managed futures. I think that one's a little more esoteric, and a lot of people are going to say, I don't know what that is.
It's interesting, and this is one of those categories that historically has not been available to investors, and certainly not in a liquid form. The managed futures category has been around for 3 decades. So as a strategy, it's been around for a long time, but historically only in a hedge fund type wrapper. So it involved paying performance fees and having illiquidity. But the reality is a managed future strategy is what's called a trend following strategy. And the one that we utilize that's managed by Mount Lucas, and they've been around for a very long time, what that invests in is a combination of commodities, rates, and FX. And the strategy, as the name says, trend following, allows you to follow the price action in these types of markets and not only be long a particular investment type, but also be short. But the point here is not to do this in a risky way. The volatility target of this managed future strategy is right around what you would see in a balanced portfolio overall. So again, it's really interesting. It has the same kind of risk profile as a typical 60-40, but it actually reduces overall risk because it's going to achieve very different returns or pattern of returns than the 60-40 itself. So we think it's a very nice complement to portfolios. We launched this strategy as an ETF back in 2021. So we have a nice track record. But as I'd mentioned, our partner in the space has been doing this for about 30 years.
So we talked about how the market's done exceedingly well, but there's still been drawdowns. The global financial crisis, in my memory, it's not that long ago, 2008, 2009, high inflation period in 22, and the COVID crash didn't last long, but in 22 also. In each of these areas, the 60-40 portfolio lost 20% or more. And that's where this kind of portfolio that diversifies into alternatives would really shine.
That's right. And I would go a step further and kind of really thinking about what's worked. Interestingly enough, in the financial crisis, bonds actually added a lot of value.
Yeah.
Because rates were high. If you go back to 2007, rates were quite high, and they were cut very aggressively, very quickly. And so that lent a boost. There was also quantitative easing. So these things lent a boost to the bond part of a portfolio. Right. And so what we're observing now is that the correlation between stocks and bonds is actually quite high. And the behavior of rates may not lend the same kind of cushion it did in other financial crises or times of stress. Yeah. So one of the reasons that we're really ringing the bell here on talking about liquid alternatives is to identify and indicate that the types of things that we relied on in the past to give us a buffer may not work. And as you point out, rightfully so, even that cushion didn't help a lot. These portfolios lost 28% in the financial crisis, 20+% in 2020 and 2022. So we're not suggesting that liquid alternatives prevent you from losing any money in a 60-40. We're not saying that at all. But there's an opportunity to dampen those losses and make the recovery that much quicker.
Yep. Well, we also have to protect our clients from themselves. We did have one client in April of this year who said, sell everything, I'm out. And that's, and as you know, the market was down over 15%. It took less than probably 2 months for it to come all the way back. It's just giving our clients a smoother ride helps everybody, I think.
It does, indeed.
Yeah. And the other point that I think is worth making is that you can't wait till a market crisis to implement this strategy. That's closing the barn door after the horse is bolted, right? You really got to think in more calm times, what is the right portfolio construction that will get us through the longer term with the least amount of volatility. So maybe you want to talk a little bit about how you work with BlackRock in their risk models and in constructing the portfolio.
Absolutely. So we've built a series of model portfolios that take a combination of BlackRock ETFs and KraneShares ETFs. Now, it's important to note that we manage 41 ETFs around the world, and they range from ETFs that specialize in emerging markets, international investing, China, but we have fixed income strategies and also a really robust suite of alternative investments, liquid alternatives that we've discussed. So by blending these two together, roughly 50-50, 50% BlackRock, 50% KraneShares, we've been able to create portfolios that are actually quite durable and unique. Unique in the sense that we're very focused on trying to think about where the markets are going to go over the next market cycle. We recognize that there are some risks that are built into a typical portfolio. Those risks have to do with concentration, oftentimes over-reliance on a particular asset class. I think right now we're seeing many advisors be significantly overweight U.S. equities and, within U.S. equities, mega cap stocks. So we tend to identify these types of risks and find ways to mitigate them. One way, of course, is to construct the portfolio a little bit differently, a more balanced approach within asset classes. And the other is, of course, having a new asset class called liquid alternatives represent 15 to 20% of the strategies. What's great is by having a partnership with BlackRock, we're able to use some of their tools. BlackRock has a phenomenal risk engine called Aladdin. It's very popular. It's well known. And we have the ability to use those risk analytics to study the portfolio bottom up. Even though we're using ETFs, we can do with a security by security and really assess the risks and then shock the portfolio. That's kind of the most important part, in my opinion. You could see what happens if U.S. equity markets sell off or volatility spikes or if 10-year yields rose or fell. And so understanding how sensitive your portfolio could be to different market environments and shocks gives you a lot of comfort in how you're designing the strategy.
I just want to drive home one point. You said, you're looking at BlackRock's, and by the way, they're the biggest ETF provider these days, I think. I mean, they're a monster.
Extraordinarily large.
Yeah, they're a monster in the industry and have a ton of resources. But just to drive home the point that, you said we're looking over market cycle. This isn't a portfolio that's looking to say, hey, this is going to go great this quarter. We're going to put 50% of our exposure in this one area.
Exactly right. So we are looking at regular kind of market changes, and we are also looking at the kinds of things that is coming from BlackRock in terms of their macro research. So what you'll see happening from quarter to quarter are what I would describe tweaks. You'll make, small changes to rebalance the strategy. We think rebalancing is very important, but there could be tweaks that you make along the way depending on what's happening with, say, emerging markets, excluding China, and China within the fixed income portfolio as rates change and duration becomes more important as a risk or not a risk. And even within our liquid alternative bucket, as we're thinking about how to construct that. But the point is, we're really focused on what's going to happen over the next 5 to 10 years and structuring our portfolios around that. And then using the tools that we have at our disposal to create as much efficiency as we can.
So any parting words? What do you think is most important takeaway for people about us putting alternatives into their portfolio?
Well, we think the time is now. We've talked a lot about some of the things that we're seeing as potential risks. And, you consider what you need in a portfolio for 2026. If you don't own liquid alternatives, we think it's something that you should own. And again, I think you nailed it. It's not to say that you need to move all your money into one thing and away from traditional stocks and bonds. But we do think it's important to add this additional balancing item in a portfolio because it's available. And truth be told, you couldn't have done this even 5 or 10 years ago. And many investors are probably happy that they didn't because the best performing asset class was stocks. But it need not be over any meaningful period of time. So we want people to have the best possible outcomes. And I would encourage, certainly you're already there, but I would encourage anybody who's watching and wants to learn more about this, they could certainly check out some of the ETFs that we offer in the space. And I'd say more importantly, talk to you, Chris, to understand, what the portfolios look like and how they should be constructed.
Yeah. Well, Jonathon, thank you so much. I think that, to me, one of the key takeaways is the best time to fix your roof is before the storm comes.
That's it.
Be prepared.
For sure.
Thank you, Jonathon. It's always a pleasure to talk to you. And to our clients, if you have any questions, please reach out to me. And if you really need a deeper dive, maybe we'll even loop Jonathon in.
Would love to do it. I'll take you up on it, Chris.
Thanks
you
very much.
All right. Be well.